Hello everyone and welcome back. This is the moment you have been waiting for. We have finally reached the chapter in the entire course, the chapter on accounting. I know you're super excited, but try to contain yourself a little bit. So this, of course, I'm an accounting person, so this is one of my favorite chapters, but of course it doesn't have anywhere near the depth I would like it to have, so there's so many other things that we need to cover, much like every other chapter that we've talked about. But nonetheless, let's jump into it and do a brief overview. So in accounting, we think about two kind of broad, sub-disciplines within accounting. I mean, accounting is huge. It includes tax and audit. And primarily in the corporate world, we think about financial and managerial accounting. And the difference hinges on who we're trying to serve. So in financial accounting, we're thinking about external users of the financial statements. So these would be investors or maybe partners, compliance or regulatory people, the Securities and Exchange Commission. I mean, it's all about people outside of the company who are trying to make decisions about whether or not they want to be an owner or don't want to be an owner. And so that's financial accounting. And then there's another piece of accounting where we're very much concerned about using our accounting information system and using our accounting data to improve our business decisions. And that is really managerial accounting. So that's kind of the two areas. Financial accounting is filled with rules and generally accepted accounting principles and standardized ways of doing things. Managerial accounting is much looser. It's more about whatever is useful or whatever provides us with the information that can be helpful. So I just mentioned GAAP, which is the generally accepted accounting principles. You can think of them as the accounting rules to the road. They include things like inventory cost flow methods and how we depreciate things and the revenue recognition principle and why we do adjusting entries, all of these different things. And you'll study those things in a future accounting course. GAAP is really U.S. based, and so the Securities and Exchange Commission requires that there be financial accounting standards. Those are turned over then to the Financial Accounting Foundation, which creates the Financial Accounting Standards Board, which creates generally accepted accounting principles for us. A similar series of entities and procedures creates international financial reporting standards, which are created by the International Accounting Standards Board, and these are international accounting rules to the road. And the way I would encourage you to think about this, imagine you're Microsoft and you want to sell some stock. Well, if you sell it in the US, then you're going to denominate your financial statements in dollars and cents, and you're going to use US GAAP. But eventually companies get to the size where they may want to raise capital all across the globe. And if you want to sell your stock on the London Exchange or in Tokyo, then you need to convert your financial statements to that country's accounting rules and then also into their currency. Somebody came along and said, hey, that's really inefficient in today's multinational global business environment. What if we created a single set of rules? And so that's what IFRS is about, is trying to get a global set of accounting standards. It's practiced a bit in Canada. It's certainly pretty prevalent in Europe, and it's also fairly common that these accounting standards be used in the less developed economies. And so you will see more and more discussion about IFRS as you go along in your business career. And there is an attempt to try to converge or bring together the U.S. rules and the international rules so that they come into alignment eventually and that we can have a single set of rules. So accounting is built on what we sometimes refer to as the accounting elements or the fundamental building blocks of accounting, and those are assets, liabilities, some kind of equity, and then revenue and expenses as sort of the base tools of the accounting equation and what we work with. So let's break those down a little bit. Assets are the things that are going to provide future economic benefits to a company. So I'm going to give examples both of personal assets and then company assets. So for personal assets, you may have a checking account, a savings account, you could own a car, maybe even own a home. All of those things would be assets. For a company, they could be similar things: cash and savings accounts, maybe delivery vehicles, patents that a company might own, furniture and fixture, property, plant, and equipment. All of these things that are going to help a company produce. Oh, excuse me, hit a button there that I didn't want to. But all of these things that are going to help a company produce revenue in the future. Liabilities are the things that require future economic sacrifices. So for you and I personally, they tend to be things like car loans and home loans and credit card debt, and then the most dreaded one of all, student loan debt. These are all obligations that we have to meet in the future, and so they require a sacrifice of some future benefits or some future assets that we may have in order to meet these obligations that exist. For a company, they're generally things like accounts payable, notes payable. Maybe a company might have some bonds, which is corporate debt, but they're obligations that you have to pay or meet or deliver something in the future. Equity is really the difference between the assets and the liabilities. It's the leftover. It represents the portion of the business that is owned by the owners, or the proportion of the assets that is funded by the owners. The equity is talked about in a lot of different ways depending upon the type of business. So we, in Chapter 4, discussed business entities or business associations a little bit. So sole proprietors and partnerships, we normally talk about capital. For corporations, we normally talk about common stock. If you were to work in the nonprofit world, the difference between the assets and liabilities would be referred to as net assets. For an individual or a person, the difference between the assets and the liability is generally referred to as the net worth. And so these are all different terms that are used for the equity in the business, or the equity that's involved, but we change the term a little bit depending upon the type of entity that we're dealing with. Revenue is the inflow of resources from performing services. So to be revenue, GAAP requires two things. You have to have a reasonable expectation that you're going to realize the money. So you have to think that you're going to be able to collect it, and you have to have performed whatever it is that you do. Sold the good, delivered the service, just whatever it is. And it has to be, both items have to exist. If one does not exist, like you have the cash but you haven't performed yet, then you've created a liability because you have a future obligation to perform. And if you've performed but there's no reasonable expectation that you'll ever get paid, you can't really call that revenue either. So that's a little bit of a difficult situation that you'll take up later. Expenses are the cash outflows. It's the things that are necessary for the creation of the revenue. So things like paying wages and paying rents and paying the utilities, those are common expenses. The cost of goods sold, if you're making something or buying something and reselling it. So those are the 5 fundamental elements, and then of course it grows from there. The chart of accounts, the number of accounts, the complexity gets much larger. So here's sort of our first basic financial statement in accounting, and this is the income statement. Generally referred to by practitioners as the P&L, but you'll also see in some books people will refer to it as the statement of operations. It's whatever name you use, it's an attempt to show the revenues and the expenses to see what your profit was, or what was left over, hopefully, after all of your expenses were paid. So you can see on this one here, we've got sales, the cost of goods sold, which is the cost of the goods that were manufactured or either bought and then sold on to customers. We have a subtotal line here for gross profit, which is the 400 in this example, and then we've got some operating expenses, salaries, advertising, rental, and then net income or profit of $100 left over. It is possible to have a loss. All you have to do is have expenses that exceed your revenue, and that's actually quite common when a business is first starting. So the P&L, or the statement of operations, or the income statement, is an attempt to show us revenue minus expenses. You might remember from assets, liabilities, equities, revenues, and expenses that the P&L doesn't show us anything about assets, liabilities, and equities, so we have a balance sheet that does that. The income statement is for a period of time, so it's the revenue and expenses that came in during the week, the month, the quarter, or the year, so a window of time. The balance sheet is what we have at a snapshot in time. So on the 1st of January, what did we have for assets, liabilities, and equities? And here you can see they've broken down the assets into current assets and long-term assets, and they also have current liabilities and long-term liabilities. Current assets are resources that we think are going to become available to us within a 12-month window, and current liabilities are obligations that we're going to need to pay within a 12-month window. And the long-term ones are the long-term assets are assets that we're probably going to have around for more than a year. And the long-term liabilities are obligations that we're going to have that are not going to get paid just within the year. They're longer in terms of their duration. And so you can see both of those items playing out here on the balance sheet, and then you can see the equity. They've not tried to tell us what kind of business the college shop is here. They've just listed equity at 150, so they haven't, if they'd used common stock, we would have known it was a corporation. If they'd used capital, we would have known that it was a proprietorship or a partnership, but they've not tipped their hand here with this particular example. Statement of owner's equity. For a sole proprietorship or partnership, this is generally capital, and it's the beginning capital plus the net income minus the amount that the owner withdrew to get to the ending capital. For a corporation, it's generally retained earnings. It's the beginning retained earnings going up by the net income and going down by dividends we paid to get to the ending retained earnings. And so it's an attempt to show some of the changes in the equity position. We'll have another statement. Let me just stop right there. It can get more complicated. You'll see that in another course. So we have a third financial statement, and I think of these three financial statements as our primary financial statements. There are others, but the income statement or P&L, the balance sheet, and then the cash flow statement. And you can see here that the cash flow statement, the statement is misspelled. Such a bummer. The cash flow statement, because we're often doing in GAAP accounting, we're doing what's called accrual accounting. Rather than measuring cash, we're measuring promises and obligations. So in a small business, you might measure cash, which is literally the inflows and outflows of cash. But as a business gets larger, we tend to make a lot of promises. We create contracts, we sell and buy goods with sales orders and purchase orders, which are governed by the Uniform Commercial Code. And so there starts to be a lot of transactions that are going on where the cash movement is happening not necessarily at the same time as the transaction. And so in an effort to try to record all of these transactions, we capture the obligations at the moment they occur, and then the cash becomes part of the accounting at a later step. That's accrual accounting. And because accrual accounting causes our income statement to diverge from our cash position, we create a statement of cash flows to come back and look specifically at why our cash is going up and down, or up or down. And we will break these inflows and outflows of cash into cash going up or down from operating activities, cash going up or down because we're investing or divesting in usually long-term assets, or cash could be going up or down because we paid off our obligations or we raised some money either in the capital markets or either by selling stock or taking on some additional debt. And so there's a lot of different ways that your cash can move up or down. And so the statement of cash flows is an attempt to try to describe these things that are going on by breaking them into these three categories. By the way, you will see all of you, regardless of your business destination, will usually take at a minimum 2 accounting classes where at least one of them will be about financial accounting, and then at some point you'll have at least one that is about managerial accounting. So this is like all of our other chapters, is sort of a really rapid fire overview, and there's a lot of material here to build out in the future. One of the main goals of accounting, it is the main goal, is to try to capture and organize information, particularly transactional information, so that it's useful. And we're looking for usefulness for external users when we're talking financial accounting, but we may be looking for usefulness for internal users when we're talking managerial accounting. And so here in the chapter, they've just done what's generally referred to as a common size income statement, where they've made all of the expenses a percent of sales for 2000X6 and 2000X7, and they have set the 2 years right next to each other so we can compare them. And so you can see here that the sales did go up by $100,000, which is, in this case, is 20% increase in sales, that's nice. You would be happy with that. At the same time, though, the cost of goods sold went up from 55% to 64%, which would not be nice, because that is going to reduce the amount of money you have left over to cover your other expenses. And you can see here that eventually our net income is only 3% of total sales in 20X7, whereas it was twice that amount in 20X6. And so these are the types of things that we can do with accounting, and we can this will give us some insights then as to where we might need to focus our attention. It seems likely in this case that the company would spend some serious time considering why their cost of goods sold went up significantly, and would explore various options for what they might do about that. And that could include raising your sales price, or managing your cost inputs, or managing your suppliers better, a whole variety of things. So as you transition out of financial accounting and into managerial accounting, one of the things that we'll do a little bit different is we'll spend some time in managerial accounting really thinking about how costs behave. And so here we have listed variable cost, fixed cost, and mixed cost. And so the way you can think about these costs, a variable cost is a cost that moves in proportion to your production. So let's say I'm making pizzas. As I make more pizzas, my dough cost and my ingredient costs are going to go up. So that's an example of a variable cost. An example of a fixed cost would be rent. As I make more pizzas, my rent cost does not change at all. And so these are important relationships, because when we begin to understand how these costs work, we can start to predict them better, and then we can start to design business models or budgets that will help us make decisions that will hopefully lead us to profitability. So watch for more information about variable cost, fixed cost. A mixed cost is a cost that's a little bit of both. A common example of a mixed cost for you personally would be your utility bill. There is a flat rate for delivering water and electricity to you, and then there is a variable cost depending upon how much you utilize. So businesses have certain mixed costs also. A common one that may come to mind is your sales staff. They may have a salary and then a commission. And so the salary is fixed, and the commission then becomes variable, because the commission is usually based on some level of production in terms of overall sales. So again, these are different ways that costs behave, and the better we understand cost behavior, we can build better models or better business plans so that we can achieve our goals. This is the break-even analysis. We saw this in a previous chapter. It was in the product development chapter, the piece on the second part of the marketing week that dealt with evaluating new products or new endeavors. And so once again, the fixed cost divided by the contribution margin will give us the break-even point. So imagine that our fixed costs are $10 and we can sell something for $5 that has a variable cost of $3. So every time we sell one, we get $5, but our costs were $3, so we kind of have this gross profit, or we have this contribution margin of $2 with every unit we sell. Now our fixed costs were $10, so after our 5th unit, we're going to be able to cover our fixed costs and we'll break even. On our 6th unit, we'll have a $2 profit, and on our 7th unit, we'll end up with a $4 profit. And so this is basically linear algebra, but we're designing a model for how we're going to break even by understanding the relationship of our price, variable costs, and fixed costs. And so this can be a very useful tool. As a matter of fact, I would rarely do a business plan without doing some simple break-even analysis first. A really good business plan is going to be a multi-month endeavor to really put together and really hone and polish, and it's going to have probably a lot of pages to it. And so there's a lot of business ideas that come up, or somebody says, "Hey, should we do this, or should we do that, or what do you think of this?" And one of the easiest ways to kind of get a better grip on an idea is to try to push it through some kind of a simple break-even analysis to see if you can just get the initial numbers to pencil or be kind of close. And then if the idea seems like it has merit, then at that point you might take it a bit further and do a more full-blown project plan or business plan or whatever you need to do a healthier, more complete analysis. Wow, that was like too fast. I mean, we should spend the rest of eternity talking about the merits of accounting. Of course, I'm being a little bit sarcastic here, but I'll just add one thing about accounting. One of the misconceptions about accounting is a lot of people think that it's really about numbers and that you have to be a math person. The math in accounting is really very simplistic. To be to have accounting in your blood and be an accountant, you have to be an organizer of stuff. Because in essence, what we're doing is we're organizing and summarizing transactional data. And so if you're a person that really likes to organize things, you love to organize your garage, or you have a hobby when you're constantly reorganizing whatever your hobby things are, that might be an indication that accounting is an area that you might enjoy, even if you don't necessarily think of yourself as a math person. Of course, it helps to not be intimidated by numbers, but the math is super simple in accounting. So anyway, that's my brief pitch on the merits of accounting. Thanks for paying attention, and we'll look forward to catching up with you next week. Take care.